talk about regulation, the problems, solutions, and ensuring a balance. Please welcome to the stage moderator for today's discussion from Trillium Labs, Melissa Watras. Joining Melissa on stage, Barry Bernstein, Managing Director of Technology Services at ViewTrade, Founder and CEO at Finalis, Federico Baradello, Adam Garetson, General Counsel and Chief Legal Officer at WonderFi, and Nisa, Amoils of A100X. Take it away.
All right, thanks everybody for joining us. We're here to talk about the ever-present, ever-relevant topic of regulations. So my name is Melissa Watras. I'll be moderating today's panel. I am the Director of Product for Surveyor, which is a market and trade surveillance solution. I'm joined by my esteemed panel, who I will ask to give a sentence or two about your background and particularly relevancy to this topic. Starting with Barry.
Hi, so my name is Barry Bernstein. I work for ViewTrade. ViewTrade is we have two entities. We have a technology aspect, services, and we also have a broker-dealer. The technology services B2B clients, order management system, control suite, compliance, and books and records.
Good morning, my name is Adam Garetson. I'm the General Counsel and Chief Legal Officer for WonderFi Technologies, Inc. We are a TSX-listed company. We own and operate primarily two centralized finance crypto trading platforms known as BitBuy and Coinberry, and we also have a crypto trading marketplace as well.
My name is Federico Baradello. I'm the founder and CEO of a company called Finalis. Finalis delivers infrastructure as a service to investment banks, placement agents, and independent deal makers globally. We currently work with 175 investment banks and have about 17 billion in total deal potential sitting on the platform today across 850 active mandates.
Good morning, I'm Nisa Amoils. I am a venture capitalist, also a securities lawyer by background, and try and help guide startups in this regulatory maze that we're in. I'm also on the board of the GDCA, which is attempting to be a self-regulatory organization in crypto.
Great. And before we get into questions, we do have to preface that there is no legal advice being given on the stage right now. This is the panelists' own opinion. So we're meeting at a really great time, a very relevant time. You know, we've had some spectacular volatility within the crypto space. You know, that kind of married to the fact that, you know, you have a bunch of fintechs who are trying to innovate in an area where regulations are gray. So what are the implications of those regulatory gray areas, and particularly the lack of clarity around policy? And Barry, I'll start with you.
So I come from the regulatory side. I like regulation. I like the rules, and I know how to act appropriately within the rules. Having a lack of clarity, I think we're speaking about crypto specifically, it doesn't mean the rules don't exist. They're out there. There's frameworks that are 5, 10, 20, 30, maybe 50 years old. Applying them to your existing business is sometimes not easy. So that gray area right now, and we know the most recent news on FTX, there's probably something that they're missing. So the implications of that is what we're seeing now. It could be bad behavior, it could be an accident, it could be risk that should not have been taken. I believe the rules are there to protect us, not just our business, but the individual consumers and the market structure. We want it to exist, we want it to survive, and the way it will survive with is a reasonable framework.
Right. Anybody else care to answer on that one?
Yeah, no, I totally agree. And WonderFi, for example, is a Canadian company. And in Canada, we have a set of rules that leverages existing securities laws. So our company holds broker-dealer licenses. So that's exactly the same as traditional broker-dealers. And we have to apply that same model with additional laws for crypto. So you take the registered framework and then you apply an additional set of rules on top of that. And what that means for us is we're not allowed to, have margin or leverage. We're not able to do fractional reserve banking or introduce those risks into our system. We're a trading platform for an asset. We take a spread and a commission. So effectively, we are a traditional broker-dealer. We're just trading in a new asset. So it's the same activity that's regulated, but almost irrespective of what the nature of the asset underlying it is.
Yeah, I would just add that if you take a step back and you think about how we got to this point, and you think about kind of the relationship or this inherent tension that often exists between the development and enforcement of regulation on the one hand and the fostering of innovation on the other hand, the pace of technological adoption has sped up dramatically. I mean, you think about the fact that ChatGPT, which was released in beta just a few weeks ago, already has millions of users, right? And the conventional wisdom around regulators being able to make decisions that are considered over an extended period of time as they think about it. You know, think about automobile adoption in the United States and how many decades it took to reach mass adoption, and the time that the regulators had to think about, you know, how that was going to be borne out from a regulatory perspective. And I think it's creating this tension that the regulator feels compelled to speed up and to effectively get ahead of these adoption waves of innovation that are occurring in the technology realm. And I think the cryptocurrency and kind of some of the blockchain issues have very much exposed the fissures that exist there. From our perspective, as a regulated broker-dealer ourselves, we are extremely proactive with the regulator, and we attend virtually every FINRA event that comes up, and we are on the phone to FINRA on a very regular basis and really working to position ourselves as a trusted partner of the regulator in helping them to understand some of the innovation that we're witnessing ourselves in our position as an investment banking back office platform.
Yeah, it feels like communication is key, is a universal truth, especially in this space.
Well, I think that's right. You know, at least in the U.S., there's this alphabet soup of regulators that touches this, and it hasn't been clear based on like the 1933, 1934 acts exactly. You know, yes, the industry is regulated, but there are certain parts of it that don't exactly fit within those old laws that were written. So I know that there's been a lot of lobbying over the past 5 years by the Digital Chamber of Commerce and the Blockchain Association and other organizations to try and get that clarity and get Congress to sort of legislate some newer language. That hasn't happened. I mean, there was the presidential executive order for responsible innovation, and now we have this situation where you have certain members of the new incoming Congress who are going to try and push through some of the low-hanging fruit, so to speak, and that might be stable coins, that might be like in the infrastructure bill, the definition of a broker. You know, there were a couple of things along the way that kind of caught the attention, but it still leaves this kind of hole where, you know, you have the CFTC and the SEC and you know, this turf war about who is going to actually be the regulator and in what instance. So I think for startups that creates a lot of expense and a lot of confusion and a lot of, you know, they're paying lawyers when you know they should be spending that money on R&D or something else. So so at least with my portfolio, I try and help them and guide them in those areas so that those expenses are kept to a minimum.
That's a great segue into our next question. So, you know, we had the global financial crisis where the narrative was too big to fail, and, you know, the pendulum shifted towards centralization. We're now seeing innovation and building out of solutions and opportunities move the pendulum completely over to decentralization and diversification of risks. So the question is, how do we regulate innovation without stifling it? And Adam, if I could give that to you at first.
Yeah, no, thanks. So I think it's very important to be cognizant with regulation that you're not stifling or prohibiting innovation, or that you're not regulating in a way that essentially gives power to monopolies that can comply with registration and regulation, like traditional players that have the capital to be able to do so. And the way I advocate to regulators in the marketplace is to think about the underlying nature of the blockchain technology and then use cases that get built on top of that, right? So you can build a use case that's a back-end system of books and records that regulators wouldn't necessarily care about anyway. That's one particular use case. On the other end of the spectrum, you've got higher risk speculative activity like cryptocurrency trading. And there you do have frameworks like broker-dealer registrations, marketplace regulation. So that is an existing set of frameworks and laws that you can apply to the activity that's built upon the actual nature of the chain. So when I talk to regulators, I say, look, you know, you got to look at what already exists from a legal and regulatory perspective and start with applying that and then see where the gaps are, right? And then you try to put gap regulation on top of those individual spaces or use cases. And you wait for innovation to come and show you where those gaps are, right? You don't try to take a regulatory sledgehammer, take it to the whole space and shut everything down. You allow innovation to grow and then do gap legislation, apply traditional laws, see where they don't fit, and then regulate iteratively on top of that. So that's the approach that I try to push regulators to think about when they're trying to get their heads around how to approach regulation in the blockchain and digital asset space.
Yeah, it almost goes back to this morning's keynote where it's like, let's learn from history and kind of apply the lessons learned there. Anybody else want to chime in?
I would just say that, one of the messages that we're often sending to the regulator is that there's a tremendous opportunity for technology to actually raise the bar and the standard that we've come to accept with respect to how regulatory compliance actually works, in our case, in the investment banking back office. And just a simple example from our own observed experience is that the vast majority of a compliance officer's time in an investment banking back office is actually not spent making high quality decisions. It's actually spent collecting information to make those high quality decisions. And if technology can be appropriately leveraged to actually decrease the error rate of those decisions and increase the level of quality and coverage that those decisions are able to deliver, that ultimately goes back to the regulator's bottom line, which is really about engendering more trust in this ecosystem, which is something that I know that the prior panel was talking a bit about. And so if you go to a first principles approach, and this is really about trust, there's a tremendous opportunity for technology to be deployed in a nimble way to actually raise that standard of regulatory compliance in many back offices.
Great.
I have some comments. So I have these meetings. It's always what's coming, when is it coming, and how much is it going to cost? We've all been there. And that's in the C-suite, right? And then there's groups, these individual groups that have to plan accordingly. So communication is key with the regulators. If too much is coming and we're spending most of our money on compliance, most of our resources that way, we're unable to innovate. And that really stifles competition, it stifles innovation, it stops things, like you said, Adam.
Yeah, and I'll give you an example exactly to both these points. So one of the things our company is able to do is offer staking on a regulated basis. So that's an example of innovation that our company brought to the regulators and said, look, this is a product. We have users that want it. We know what the marketplace is doing. We have the data. We bring it to the regulators and say, this is the product we want to do, and here's how we want to go about achieving that. From that came a set of terms and conditions that were in addition to traditional broker-dealer rules about how you do disclosure, how you provide risk statements, and how you roll out a product to individuals. So now we're able to offer ETH staking, Polygon staking, Solana staking, all within the regulatory framework, right? So to me, that's a fantastic example of you have innovation and you have regulation coming together to offer a more trusted product from a marketplace perspective.
Yeah, a trusted product and a better user experience too.
Exactly, 100%.
Yeah. Okay, so in theory, then it sounds like if you're a reg tech within the digital space, you want regulation, right? Because it gets people more comfortable, and if you get people more comfortable, then you're opening up lines of potential capital to leverage. So with that in mind, is that right? And second, we know it's right for Barry because we know that you're a fan of regulations, but and then secondly, what do we see kind of coming down the pike? To borrow, Nisa, your phrase of the kind of alphabet soup of regulators, we do see them kind of coming to alignment that something needs to be done. So what do we envision that manifesting as? And Federico, if I could give that to you to kick off.
Yeah, absolutely. I mean, I think that, just kind of to continue the thread of what I was mentioning earlier, our position as a business is to have an extremely proactive approach with the regulator. And part of that proactive approach is actually picking up market signals with respect to what our investment banks, placement agents, and independent deal makers are actually seeing happen out there in the capital markets realm. We have quite a bit of coverage as a business. We support effectively every industry vertical under the sun is being supported in some form or another and represented as a mandate on the Finalis platform. And so we see a lot as a reflection of that. So for example, as it relates to digital assets, right? We do come across transactions that have a component of the consideration being some kind of a tokenized security, right? And that prompts a conversation with the regulator in terms of, well, how would you actually look at this from a regulatory perspective to make sure that, from a back office perspective, we're addressing all the appropriate checks and balances as it relates to making sure that the transaction is fully compliant from a FINRA and SEC perspective. And so what I would say is, and as Barry was mentioning, this really comes down to communication and a relationship built upon trust and transparency with the regulator. And then ultimately cascading that down to a user experience reflected in what for Finalis is our Finalis platform that ensures that we are collecting all the appropriate information so that we can apply those checks and balances. And also reflecting that point in terms of what that judgment represents in terms of the type of information that we need to collect as a compliance operation is going to evolve in a dynamic way. And so we've built that right into the guts of our technology where those workflows are very dynamic. And if we have to make modifications of workflows, we can make that modification in less than 24 hours. And that is immediately then reflected in a new set of questions or parameters that our clients have to follow in order to make sure that their deals remain in compliance.
Right. Nisa, would you care to follow up?
I mean, the Ripple SEC case will be decided probably Q1. And there's a lot of precedent setting there as well. As it applies to the Howey test, like what is a security, what's not a security, and whether or not DeFi falls under existing bills that are sitting there waiting in the House, like the DCCPA or the Gillibrand bill. So, I think that there's a push to get some clarity on some of those questions, at least in Q1, from what I've seen from being in DC. And then I think then after some of those kind of low-hanging fruit is passed and we have some clarity there, I think the next thing will be on NFTs and right. Whether those are securities or fractionalized NFTs are securities, and like there's a lot of misinformation on what you're actually getting. Is it a certificate of authenticity? Is it the copyright? Like there's the basic consumer doesn't really understand what they're getting when they're buying that. So I think there's like a progression, and then of course counterparty risk, which is playing out now in crypto and KYC, AML, and the travel rule and FATF and all of that still being worked out on a global scale.
Absolutely.
I don't think we'll see regulation clear in 2023, maybe the year after. But that doesn't mean between now and then we shouldn't pay attention, right? Even if it's lawful, it could be awful. We're all smart. We all went to school somewhere. Yep. We have to protect our business. We have to protect our investors. We have to protect our users' experience, whether it's personal identifiable information or something else. The regulators, we know, they don't want to break anything. And it takes time. That being said, I always say just make sure your books and records, make sure you have a good system, maintaining what you did. Yep. You have a good reason for doing it. Make a good case for it. And that case should not only protect your business, risk perspective, but also your customers. At ViewTrade, we have a control suite. Digital onboarding, we maintain everything. We keep it. It's stored in our system. Then part of that control suite, whether it's KYC, CIP, or in the back end, we make sure you have books and records, and we store them. And the fintechs, sometimes they feel they're not regulated, but I think we're all regulated. Someone's in charge of me right now. I know we're all somewhere. So I think you just need to be prepared. Do what's reasonable, do what you think is fair, and have a good reason to do it.
Yeah, I think that's a really powerful point too, to be able to explain why you had made a decision and kind of come up with the defendability of that rationale as well. All right, so we have about 5 minutes left. I'm going to throw everybody a little bit of a doozy. I apologize in advance. But what scares you? And to make that a slightly more productive question, how can the audience members here hedge against regulatory uncertainty? I'll let you guys decide who goes first.
Sure. Why don't I jump in? So the thing that scares me is the fact that the industry's been around for so long, but there's no regulatory clarity essentially in the US, or that regulators haven't come together in this period of time, right? And I always contrast that with the Canadian model, where we've had Bitcoin ETFs now for 3 or 4 years. We've had futures around crypto. We've got staking. We've got registered platforms, right? So there's this inability of regulators in the US to work together, which is certainly a challenging piece. And what I find regulators try to do is get things perfect right off the bat in an all-encompassing way. And the space is moving so quickly that that's really not a reality, right? So start iteratively, like start with a piece at a time. Right? There are traditional frameworks. There are certain laws that you can put in place. Find the use cases that have the most user adoption or in the highest risk category and go there. Don't try to use a sledgehammer. Try to use something a little bit more tailored.
And that's exactly what fintechs try to do, right? We're always trying to iterate and build it out. You're not trying to get it perfect immediately. So it's a good parallel between the two.
And that's the partnership that you need with communication and dialogue between the industry and regulators. And just to dovetail, that really allows industry participants to be able to expect where they're going, right? And say, look, we don't need to comply with all the laws. Here's a small subset. We can apply them to our business. We know where that's coming from. We understand the framework that we're probably going to fall into. And at least there's, that pairing that can occur.
Yeah.
For me, it's, I'm afraid, capital formation, right? This is market structure, the United States, but the world. If we injure some of these investors, whether we do it by accident or on purpose, whether there's fraud, they'll go away forever. Everybody remembers 2008, 2009, we lost probably a generation of investors. That's a real problem for capital formation in our country. That's a mortgage, that's a boat, that's a house, it's something.
Livelihood.
The lack of regulation or the lack of clarity, or some of these bad actors, they don't just make it bad for themselves, it's all of us, right? Adam has to succeed in order for me to succeed. Federico, all of us have to succeed. So we have to do it together. So when we read those articles about somebody, bad actors, we're not like, oh my gosh, you should have came to us. We're like, make it terrible for everybody. So that's what I'm scared about. I'd like some more clarity in this space.
The risks I worry about are really the risks that we don't know that exist. I think to a certain extent, we've built controls within the business that are focused on robust relationship with the regulator and robust controls around known risks. I think one of the things that for me has been really shocking, even just over the course of the last several months, is how quickly unknown risks become manifest and then turn into contagion. Discipline internally, within our own risk committee within the firm, to try to read the tea leaves and anticipate risks that may emerge, because these things have a way of rearing their ugly heads incredibly quickly and impacting business bottom lines, such as ours, very quickly as well.
I think probably the SEC is the scariest one for startups, because their position has been, come in and talk to us and then get served with a Wells notice or something. So I think it's really confusing for startups, and they're spending a lot of money, as I said, like trying to figure that out and trying to comply, or else they're leaving the country, and that just isn't the place like the U.S. wants to be in. Like, it's just not. So we have to just. Like there's Hester Peirce with her safe harbor. Is Ethereum going to be considered a security? Like, that's on the table right now, right? On the Hinman speech. So it's really kind of like scary for a lot of people, just not knowing, and not knowing even if they're a good actor how to comply. And even if, TradFi is regulated, but there's criminals there too, right? So it's just not going to prevent fraud completely, but there's a lot of good actors that want to, be able to know that they are on the right path, and they just don't know.
Absolutely. Well, great. So it sounds like, just to kind of summarize the conversation, some key themes are communication, continuing to innovate within a pragmatic, existence and just, keeping pace and, keeping a pulse on kind of what's emerging. Miss any common themes there, key themes? I think that's everything.
I think that's it.
Yeah, I think that's right. I think it's, the panel's pretty supportive of regulation up here, but obviously we're all looking to innovate in the space too. So you've got some real world actors trying to make that happen. And this is the approach that we're taking.
You just have to partner up with good technology vendors, solving a lot of regulatory problems with technology, make yourself efficient and always effective.
And I would just add a proactive approach with the regulator is very important.
Excellent. All right. Well, thank you to the panelists and thank you to everybody here. You could find us outside, but appreciate everybody taking the time. Thank you.
Yes, indeed. Keep it going for this expert panel. Nisa, Barry, Federico, Adam, and Melissa. Thank you all so much. Listen, for our friends in the back,